Good afternoon, everyone, and thank you for joining us today for our webinar on notice periods and redundancy payments. This is actually part 2 of our dismissal series, so thank you for joining us again if you joined us last week, and to all of you that are joining us this time, please feel free to look up the recording for the previous part on our YouTube channel, which you will receive a link to following this webinar. We actually send a recording and a link to our YouTube channel for you to explore within about 3 days of the webinar. For our webinar today, we have muted all attendees. If you have a question, please use the chat box in your control panel displayed on your screen. We will endeavour to actually get back to you with those queries and put them on a Q&A form in the mail out that you receive. We can't promise we'll answer all, but we'll do the best of our ability. For those of you that do not know me, I am Angela Lehmann, the Legislative Manager here at ADP. I will be talking, I'll be emceeing as best as I can with being a bit under the weather, and I'll also be discussing some of the tax implications of our topic today. We are joined today by David Bates, Managing Director of our HR partner Workforce Guardian. Hi, David.
G'day, Angela. How are you going?
Yeah, not too bad, thanks, David. Thank you for coming along again and for providing yet some more riveting information for everyone online.
Yeah, it's an absolute pleasure. It's going to be a little bit tricky today because I'm in Sydney, obviously, and you're in Melbourne. Although it's probably good because it means I won't catch whatever it is you have. But it's great to partner with you guys as always.
Yeah, thanks, David. Well, we have a fair bit to get through, and you're going to kick us off, so I'll hand it over to you. Thanks, David.
Thanks a lot, Angela. Appreciate it. And g'day, everyone. It's a real pleasure and a privilege to have your company this afternoon for, as Angela said, part 2 in this webinar series all about notice periods and redundancy pay, continuing on from our earlier discussion last week. Now, obviously, this is a very hot topic because a lot of you, like hundreds of you, have decided to attend today's webinar. So I hope you will find it very useful information. What we'll be doing is speaking to you for around 30 to 40 minutes. And the key topics that we're going to cover off in today's webinar are now shown for you on the screen. So you'll notice that we're going to be talking about, firstly, the applicable legislation. So what is the law when it comes to notice periods and redundancy pay? So in other words, where do you source your obligations? We'll look at that first. Once we've done that, we'll then look at notice periods and the Fair Work Act specifically. So what does the Fair Work Act say about notice periods? And then we'll drill down even further. And we're going to look at notice periods within 2 specific contexts. We'll talk about notice periods when you're dismissing an employee from your business and notice periods when an employee is voluntarily resigning from their position. And then I'm going to finish off by talking about redundancy payments. So when do you need to make redundancy payments, and furthermore, what is the quantum or the value of those redundancy payments when they do actually need to be made? And as Angela mentioned at the beginning there, I'm going to then hand back to Angela where she's going to take you through the tax considerations that apply in relation to notice periods and redundancy payments. So quite a bit to get through, but we will get through it, I'd say, in about 30 to 40 minutes. So without further ado, let's talk about the applicable legislation. Well, for any of you who joined us for last week's part 1 webinar in this 2-part series, you'll know that most private sector employers in Australia are covered by the Fair Work Act of 2009. Now, really, any private sector business operating in the country other than in Western Australia will almost certainly be covered by the Fair Work Act. In Western Australia, though, there's a 2-part requirement, if you like. Firstly, the business does need to be operating effectively in the private sector, but secondly, the business needs to be an incorporated entity, which would in most cases be a PTY limited business. If your business is in Western Australia and you're a sole trader or an unincorporated partnership or indeed an unincorporated entity of any other kind, then your business will actually fall within Western Australia's state-based industrial relations system. So there is just that little extra step you need to go through in WA to verify which legislation applies to you. And it is critical to get that right because the Fair Work Act is different from the Western Australian state workplace relations laws. So definitely don't assume that your business is covered by the Fair Work Act if you're in WA. Just make sure you double check. Now for everyone, it is absolutely critical that you do get good advice about your obligations. So don't Google your obligations in relation to notice and redundancy pay, please. Do make sure you get some really good advice. Also worth mentioning that the Fair Work Act has of course been with us now for well over 6 years. So one of the consequences of that is that Australia's employment authorities, and there are two of them, the Fair Work Ombudsman, the FWO, and the Fair Work Commission, these two agencies really don't give much leeway anymore when it comes to employers who are unaware of their obligations. Their view is that employers have had more than 6 years to get used to this legislation. So it is a great thing that you've spent some time this afternoon coming along to join this webinar, because the more information you have, the better, because the more information you have, the less chance there is that you'll unintentionally break Australian employment law. Okay, so we know now that the Fair Work Act almost certainly covers your business. Let's talk now about these different obligations. What does the Fair Work Act say about notice periods? Well, the first thing to note is that notice periods come from the 10 national employment standards. Now, if you've attended any of our Workforce Guardian from ADP webinars in the past, you'll know that the 10 national employment standards are the minimum terms and conditions of employment that must be provided to employees. These 10 NES entitlements cannot be bargained away, they cannot be reduced by mutual agreement. So even if you and an employee would rather trade off one entitlement for another, you simply cannot do that in relation to any of the 10 national employment standards. Now, as notice comes from the 10 national employment standards, that means that you cannot bargain away or get out of your obligations to provide notice to employees who are entitled to receive notice. Really important to remember that. So if an employee is eligible to receive notice, you need to provide it. And if you do fail to provide it to an eligible employee, well, then that's going to result in a very serious breach of the Fair Work Act. And in fact, we routinely see this here at Workforce Guardian from ADP. We see employers who might do everything else right when it comes to letting an employee go, but then they fall at the very last hurdle because they don't provide the applicable notice period. So absolutely crucial to realize that notice does come from these immovable 10 national employment standards, which must be provided to all eligible employees. Right, so we now know that notice is one of the 10 national employment standards, and you would have heard me mention that it applies to eligible employees. So who is not eligible to receive notice? Well, the Fair Work Act makes it clear that some employees are not covered by the obligation to receive notice. Some employees simply do not receive notice when they're being let go. And what you can see on your screen there are 4 of the categories of employees who are not entitled to receive notice. Now the first of those is independent contractors. Really important to note that there is a clear legal distinction between a person who is a genuine independent contractor and a person who is an employee. Now unfortunately it gets even more complicated because the test that's used to determine whether someone is an employee or a contractor for employment or fair work purposes is actually quite different and distinct from the test that's used by the Australian Taxation Office to determine whether someone is a contractor or an employee for tax law purposes. That's right, ladies and gentlemen, 2 of our government departments not necessarily communicating with each other very well, resulting in 2 different legal tests. But the key point here for the purposes of this webinar is that if the employee is an independent contractor under the Fair Work Act, then they are not entitled to receive notice because only employees are covered by the national employment standards, and accordingly only employees have a guaranteed right to receive notice. Now the second category of people who don't receive notice are casuals. So a person who is employed as a genuine casual employee who is being let go under any circumstances will have no entitlement to receive notice because indeed it's the very nature of casual employment that it is uncertain, so therefore there would be no entitlement to receive notice upon dismissal. Now there is a little asterisk there next to casual employees, and that's your classic some conditions apply. And what I really want to emphasize here is that even though casuals have no entitlement to receive notice, they can still become protected from so-called unfair dismissal. So an employee who's a casual and who has completed the applicable minimum employment period, which will either be 6 or 12 months depending on the size of the business, and a casual who has not just completed that minimum employment period but who also has a, quote, reasonable expectation of ongoing employment, well, those casuals become protected by the unfair dismissal laws. But even so, if a casual who is protected from unfair dismissal is ultimately let go, they still have no entitlement to receive notice. Again, that's just the nature of casual employment. Now, a third category of people who do not receive notice are employees who are being let go at the end of their fixed-term contract of employment. So, let's imagine you've hired someone to work in your business and you've employed them to work for a fixed-term period of exactly 8 months. So their contract has a clear end date in it. If you let the employee go at that end date when the contract expires, well, then there's absolutely no obligation for you to provide notice because you are letting the employee go at the already mutually agreed end date. However, if you are wanting to let that employee go before that end date, or if you allow the employee's employment to continue after that end date, then you are going to become required to give notice. And that's because the fixed term period of employment really is no longer of any relevance. You are now terminating the employee outside of that fixed term period, and therefore notice would be required. And the final exception to the notice obligation is where you're dismissing an employee for what's called serious misconduct. Now, under the Fair Work Act, serious misconduct generally covers 3 different types of things. The first is where the employee has engaged in workplace violence. The second is if the employee has engaged in theft. And the third is if the employee has engaged in any form of fraud. So theft, violence, and fraud will generally amount to what's called serious misconduct. And if an employee is let go for serious misconduct, there is no requirement to provide them with notice. Now, just one important point here about dismissing employees without notice. Even though you have the right to let them go and not provide either notice or payment in lieu of notice, you still need to follow a fair and reasonable process, and it's also critical to note you are still expected to provide the opportunity to the employee to show cause why they should not be dismissed before you confirm your final decision. That's what we call a show cause opportunity. So if you have gone through that process, you provided the employee with a show cause opportunity, but at the end of the day you have decided that they engaged in serious misconduct, well then you're entitled to dismiss them and you would not be required to provide them with notice. Okay, so if you do end up dismissing an employee, and if that employee is required to be given notice, the logical question is, well, how much notice do you need to actually provide? Well, the Fair Work Act contains its own table which confirms the minimum amount of notice that needs to be provided when you're dismissing an employee. And as you can see from your screen now, the amount of notice that you have to provide is based on the employee's period of continuous service. So in other words, the amount of time the employee has worked in the business. So if they've been there for less than 1 year, their minimum notice period is 1 week. And note that that obligation applies even if the employee is still completing what we sometimes call as a probationary period or any other sort of introductory period. If the employee is anything other than a casual, and if they're being let go for anything other than serious misconduct, as we've just seen, then they're entitled to receive 1 week's notice during that first 12 months of employment. Now, once they've completed between 1 and 3 years, they're entitled to a minimum of 2 weeks' notice. 3 to 5 years, they get 3 weeks. And if they've completed more than 5 years, they become entitled to a minimum of 4 weeks' notice. Now, one key point to note here is that once an employee has completed at least 2 years of continuous service, if they are then dismissed and they happen to be over 45 years of age, they become entitled to 1 additional week of notice. So if we use that last line of the table there, if you've had an employee in your business who is aged 50 and they've been with you for more than 5 years, they would, of course, now become entitled to 5 weeks' notice. So these are the minimum notice periods that must be provided to eligible employees. And remember, there is that 1 additional week of notice in certain circumstances. Now, what happens if you decide that you'd like the employee that you're dismissing to finish up straight away? Well, the Fair Work Act refers to this as payment in lieu of notice. So if we were to use that same example, an employee who's been with you for many years that you're now letting go and who's aged over, let's say they're aged 50, that employee, as we just saw, is entitled to receive 5 weeks' notice. But you might have some genuine concerns about that employee remaining in your workplace after you've confirmed that they're being let go. In those circumstances, or in any circumstance really where you're letting an employee go, you have every right under the Fair Work Act to pay out the notice period in lieu of it being worked. So instead of having that employee work the full 5 weeks in your business, you could simply say to them, I'm going to pay you 5 weeks in lieu of you working it out, and therefore employment would end as of that date. Now that's a really important point. When you decide to pay out notice in lieu of it being worked, it means that the employee's final date of employment is that date itself. Because if you were to have the employee work through the notice period, their final date of employment would of course be the last day that they actually perform work for you. So in the example we've been using, that would be at the end of that 5-week period. The reason that this distinction is very important is because employee entitlements such as paid annual leave continue to accrue for as long as the employee remains in employment. So if you were to dismiss an employee today and explain to them that their dismissal is taking immediate effect because you're paying out 5 weeks in lieu of notice, then you don't need to accrue anything further beyond today towards things like annual leave. In contrast, if you told the employee that they were required to work through the 5-week notice period, they would of course continue to accrue annual leave during that time, which means the amount of unused annual leave you'd need to pay out at the end would be slightly higher. So it is just worth keeping in mind that it's critical to correctly determine the date employment comes to an end, and that is affected by whether notice is worked through or whether it's paid in lieu. Now, if a contract of employment that you've issued to an employee contains a more generous notice period, then that more generous notice period can generally be enforced. It can't be enforced through the Fair Work Commission or via the Fair Work Ombudsman because those agencies only deal with entitlements that come from the Fair Work Act. And if we're talking about a more generous notice period which has been provided by a common law contract, then only a court can enforce that. Which is why if you were to, for example, dismiss someone and only provide them with their minimum NES notice period, when in fact their contract contains a much more generous notice period, that employee could then file an application against you in the relevant court, and they would seek to enforce that order or enforce that contract by way of a judgment from the court. So if you are going to include more generous notice periods in your contracts, just keep in mind that they do generally work both ways. So do make sure if you are going to provide a more generous notice period that it's clearly described in the contract. And lastly here, just again remember that if the employee engages in serious misconduct, they will forfeit their right to receive notice. So in those circumstances, it could save you quite a bit of money if you ultimately are able to confirm that the employee has engaged in serious misconduct. Okay, so that's notice periods in relation to dismissals, and of course that's when this particular topic comes up most frequently. But there's another circumstance that we do get asked a lot about here at Workforce Guardian from ADP, and that's when employees resign, are they required to provide notice themselves? Well, what's interesting to note here is that the Fair Work Act itself does not impose any notice period obligations on employees who are resigning. So if an employee is covered by the Fair Work Act and they're not covered by a modern award or an enterprise agreement, they in fact actually have no statutory obligation to provide you with notice in the event of resignation. But again, as any of you who will have attended our previous webinars will now know, most Australian employees are in fact covered either by a modern award or by an enterprise agreement. And virtually all modern awards and enterprise agreements will impose notice obligations on employees, which are the same as the notice obligations that apply to an employer when they are dismissing an employee. So what you'll find is that, for example, most modern awards contain a term which says something like, if the employee resigns, they are required to provide the employer with the same period of notice as the employer is required to provide in the event of dismissal. So in those circumstances, you then have a statutory right that you can enforce, you as the employer can enforce, which will require the employee to give you that period of notice. And so in order to give teeth to that, most modern awards and enterprise agreements then go on to say, if an employee fails to provide that minimum period of notice when they resign, you, the employer, become entitled to withhold from the employee's final pay an amount equal to the wages that would have been given to them during the notice period they failed to provide. So let's use an example to make that as plain English as possible. Let's say again you have that employee who's required to give you 4 weeks notice, and that employee only gives you 1 week's notice. Well, in those circumstances, you would be entitled to withhold from the employee's final payout an amount equal to 3 weeks' wages. So they are the only circumstances when you can make a deduction like that from the employee's pay. It's only where an award or an enterprise agreement imposes a notice obligation, the employee fails to provide that period of notice, and the award also states that you have the right to make that deduction. In those circumstances, you can go ahead and do it. Now, one other point here that we get asked about a lot is, well, what happens if an employee provides more notice than they're required to under the national employment standards? Can I, as the employer, refuse to accept that longer notice period and only endorse or accept a shorter minimum notice period? The good news is that the answer to that question is yes. So again, let's say you have that employee, they're required to provide you with 4 weeks notice. And instead of doing that, when they come to you and announce their resignation, they might say to you, look, I've got another job, it's starting in 10 weeks, so therefore I'm giving you 10 weeks notice. Well, you as the employer actually have the right to say, well, I accept your resignation, but I am only going to accept 4 weeks notice because that's all you're required to provide to me. The other 6 weeks, not going to recognize that at all. So in other words, I'm accepting your resignation, I'm enforcing the minimum notice period, and I am not going to recognize the rest, so your employment ends in 4 weeks. You also have the right to say, if you wanted to, no, I'm not going to accept that longer notice period, and in fact I'm going to pay out that 4 weeks in lieu of notice. So you can finish up today and I'll simply pay you out that minimum notice period. So you can certainly enforce the minimum notice periods if an employee provides you with a longer than necessary notice period. So we've looked at notice periods in relation to resignations and in relation to dismissals. What about redundancy payments? Well, just like notice periods, redundancy payments also come from the 10 national employment standards. So once again, we know that they cannot be amended by mutual agreement, they cannot be bargained away, etc. They must be provided as a matter of law to eligible employees. But it's critical to note that redundancy payments, the right to receive a redundancy payment, is a separate and distinct right from your right to receive or to give a notice period. So in other words, if an employee is being made redundant, if their position, I should say, is being made redundant, then there may be an obligation to provide both notice and, separately, a redundancy payment. One doesn't offset the other, one doesn't cancel the other one out, and they aren't mixed together. They are two quite separate and distinct entitlements. And just like failing to give the minimum period of notice, the failure to provide the applicable redundancy payment to an eligible employee also amounts to a serious breach of the Fair Work Act. Now, as we've seen before with notice, some employees aren't entitled to receive notice, and in the same way, some employees are not entitled to receive a redundancy payment. So what you've seen there on your screen now are just 5 examples of employees who have no right to receive a redundancy payment if their position is made redundant. So clearly and logically, if the employee is being let go for any reason other than a redundancy, let's say they're being dismissed for serious misconduct or just general underperformance, in those circumstances there'd be no need to make a redundancy payment because there has in fact been no redundancy at all. It's just a standard dismissal. Secondly, an employee who has completed less than 12 months service also has no entitlement to receive a redundancy payment in the event of redundancy. Now keep in mind that that employee would still be entitled to receive notice unless they're a casual, but they would not be entitled to receive a redundancy payment because of that 12 months of service requirement. Similarly, employees who work in a small business, which is defined as a business with fewer than 15 employees by headcount, employees working in those small businesses are not required to be given a redundancy payment if their position is made redundant. And just like notice, casual employees are also excluded from the right to receive a redundancy payment. And interestingly, apprentices too do not generally receive redundancy payments if they're being let go. So, if you've ultimately determined that a particular employee is entitled to receive a redundancy payment, the logical question, of course, again now is, well, how much do I have to give them? Well, just like notice, the amount of redundancy pay is also based on the employee's period of continuous service with the business. And you can see the sliding scale demonstrated for you in the table on the screen. So if an employee has completed less than 1 year of employment, as we know, they get no redundancy payment in most cases. So this table begins with an employee who has completed between 1 and 2 years service. Now what's interesting here, as you'll see at the very bottom, is that if the employee has done between 9 and 10 years of continuous service, they receive a redundancy payment of 16 weeks pay. However, once the employee then clicks over and has completed at least 10 years of continuous service, their entitlement actually drops by 4 weeks and they end up with only 12 weeks pay. Now lots of people think that we've made a mistake here. They contact us and say there's something wrong with your table because you've reduced the amount of redundancy payment at that very last stage. Well, I can assure you that the table is correct. The reason for that reduction is because once an employee has completed 10 years of service, they are guaranteed to receive a payout of their accrued long service leave. So what the Fair Work Act does is it recognises that, so it reduces the redundancy payment just by a little bit to sort of compensate the employer for the fact that they also have to pay out the employee's full long service leave entitlement. So it's to avoid, if you like, a little bit of double dipping. That's why you get that 4-week reduction at the 10-year mark. Now, one final thing to note about redundancy payments. There are, of course, exceptions to every rule. So what you'll find is that a lot of employees in Australia are covered by what are known as industry-specific redundancy schemes. These are redundancy schemes which, as the name suggests, have been developed for a particular industry or in some cases an occupation. And you'll find details of these industry-specific redundancy schemes in the applicable modern awards themselves. So let's take the Building and Construction General On-Site Award as a good example. That award contains its very own unique industry redundancy scheme. So all of the terms and conditions relating to redundancy that are found in the Fair Work Act are effectively replaced for employees covered by this award by the redundancy terms contained in the award itself. And what we'll find whenever there is an industry-specific redundancy scheme is usually that it provides far more generous entitlements to the employee than the National Employment Standard minimums, and in many cases they will also apply to small businesses. So where a small business would otherwise be exempt from the obligation to make a redundancy payment, if their employees are covered by an award which removes that exemption, then they will become bound to provide them. So always critical to look at the applicable modern award or enterprise agreement just to see whether there might be an industry-specific scheme in place. And I just mentioned enterprise agreement, so it's worth pointing that out again. If the employee is covered by an enterprise agreement, absolutely critical that you also check that agreement carefully, because it will absolutely, without doubt, contain its own redundancy plan. Okay, so now that we've looked at redundancy and notice from an employment law perspective, I'm actually going to hand back over to Angela now to take you through the tax implications of these areas of employment law. So over to you, Angela.
Thanks, David. I'll begin by mentioning that I am only going to specifically look at genuine redundancies today. Just in our part 1 of the dismissal series, I actually did go into ETPs more generally, so I will focus on genuine redundancies. Again, as I mentioned at the beginning of the webinar, if you do have any queries, just shoot them through and I will do my best to answer them and send them through with the recording afterwards. I'm going to start off with the basic requirements now. For those of you who have been following these webinars for a little while, I have made a point of saying that the genuine redundancy rules for tax purposes are quite complicated and there's a lot to them. So first and foremost, the basic requirements. The first point sounds a bit ridiculous, that the payment must be made as a consequence of the employee's termination, but that's there for a reason, and that is because when we are, as employers, trying to establish what the redundancy amount is and how much of it forms part of an ETP, it is important to remember what part of the payment is actually in consequence of the employee's termination, and then more specifically to the redundancy of that employee's position. The second dot point is termination involves employee being dismissed from employment. Now, again, it seems like a very straightforward dot point and it seems kind of irrelevant, but that also helps explain, for example, in circumstances where there's some form of voluntary element to a redundancy, when the tax office would consider it still being a genuine redundancy or not. So there are some scenarios in some of the guidance I will refer you to shortly. The third dot point is dismissal is caused by the redundancy of the position, and honestly I should have underlined the word position. It's often that I hear employers or clients say to us, oh, that person, we're making that person redundant. You don't make a person redundant, you make a position redundant. It means that it is no longer required and that role is not to be replaced because it is not a role that you need to carry on your business. The last dot point we have there is redundancy payment must be genuinely due to redundancy. So that the redundancy is exactly why this redundancy payment is being paid. There's no other sort of agreement that's been made in the background or just used as a way to access further tax concessions. So a lot of these seem ridiculously basic, but they do have a purpose. So as if that wasn't enough conditions to satisfy, there are actually further conditions that the tax office outlines for a payment to be deemed a genuine redundancy. The reference I was referring to is on your screen now, Tax Ruling 2009-2. Now, this is a 70-page document full of guidance on genuine redundancies. It does go into quite a lot of detail and fully explains each of the basic conditions, each of the further conditions we're about to discuss now, but it also gives very good worked examples for all the different scenarios as well. So it may be a bit daunting to look at a 70-page document and think, I don't want to read the entire document, but you know, it's nothing a Control F won't fix, because if you have a specific example, they're actually very good and very layperson examples that that you can use to sort of understand the process. So the further conditions, as I said, the dismissal must be before the age of mandatory retirement. So the documentation is referring here to age-based limits and retirement limits. So those are subject to change at the moment. they were announced as part of the budget measures that they might be revisited. So that might be subject to change, but we're dealing with age-based limits there. Payment must be made before the end of a fixed term period. So as David mentioned, if you're going to terminate someone at the end of a fixed term period, it's not really considered a genuine redundancy at that point in time. It's actually only going to be relevant if you are breaching that fixed term period. Payment must be made at arm's length, which is fairly self-explanatory. And here is the point of difference with some of the other law and HR and employment law we've been discussing with David. No stipulated arrangement to re-employ. And when we say re-employ, rehire that employee that you're making redundant in any capacity. And also it includes associated entities. So even if an associated entity of the original employer has an arrangement in place to rehire that employee, it could invalidate the redundancy being treated as a genuine redundancy payment. So it's just something to be very mindful of when you are looking at these types of scenarios. The last one is payment not in lieu of superannuation benefits. So if it's something that ordinarily you should have been paying into the superannuation fund of the individual and you're paying it as part of a ETP or redundancy in lieu of that, then it actually does not meet the... So I know there's a lot to get through and there's so much more detail I can provide on what constitutes genuine redundancy. But I think I'll just move on to calculating the tax amount. So a lot of you will be aware that genuine redundancies come with a tax-free limit. It is revised every year. For the 2015-16 year, we have a base amount of $9,780 plus $4,891 for each year of completed service. Again, can I emphasise each year of completed service, no part year entitlement there at all. So if, for example, I've worked with my employer for 4 years, I get the $9,780 plus 4 times $4,891, sorry everyone, for my period of service. So for example, if we do use the 4 years, that should work out to roughly $29,344. So if I get a redundancy payment of $25,000, which is under the $29,344, then presumably my whole redundancy is under the tax-free limit and there's no tax to pay. If, however, there is a remainder of ETP over and above the tax-free limit, so for example, I got $35,000 as part of my redundancy package, the remainder over the tax-free limit is taxable and it is subject to the ETP cap. So for those of you who joined us for the last dismissals webinar, we did talk about there's various caps and they do apply in different scenarios. When you are dealing with the component of the taxable component of a genuine redundancy which is over the tax-free limit, you need to subject it to the ETP cap. Then the other note I have for you on this slide is you would tax it concessionally in accordance with Schedule 11, which is a resource we provided to you in the last webinar also, which is the tax table for employment termination payments. Finally, reporting. So I think we might have touched on this again last time as well, but if, for example, the entire redundancy is under the tax-free limit, then there's no tax payable, then you can disclose the payment under lump sum D in the individual payment summaries which you issue at the end of the financial year. If there is a taxable component, however, you actually need to issue a separate payment summary, which is known as the ETP payment summary, and that needs to be issued to your employees within 14 days of the payment being made. And again, we've given you the references to that payment summary in the previous webinar slides. So please make sure you check into that as well. So that's all I was going to touch on today. It is quite complicated and I could be here for a webinar session on my own going through all the conditions and all the various proponents to a genuine redundancy, but I hope we have armed you with some good knowledge and some questions you can go away and ask and some resources that you can refer to. If you are a client of ADP, you're in luck. You actually have access to the ADP Workplace Advice line, which is provided to us by our Workforce Guardian partner. The Workplace Advice line number is 1300 443 088. And David's team will be happy to answer any employment law or HR questions for you. If you are not an ADP client and you're interested in finding out a bit more about what we do and the subscription services from Workforce Guardian, then please feel free to give us a call on 1800 000 729. David, thanks again for another exciting dismissal session.
My pleasure, Angela. Thanks again for having me along.
Thank you everyone for partaking, and as I said, we will be following up within the next few days with the recording and any questions we have been able to answer for the session. Thank you very much, and hope you join us again next time.
Thanks everyone. Bye for now.